The Federal Reserve has created a 10 trillion shadow debt bomb through reverse repos and overnight lending facilities that's completely invisible to most Americans. This hidden liability will trigger a liquidity crisis worse than 2008, destroying the dollar's purchasing power by 60% and forcing the Fed to choose between hyperinflation or economic collapse by 2026. Right now, at this very moment, there's 10 trillion sitting in the Federal Reserve's balance sheet that didn't exist before 2020. $10 trillion. That's more than the entire economic output of every country on Earth except the United States and China. And here's the kicker. Most Americans have absolutely no idea it's there. While you've been watching your grocery bills double and your rent skyrocket, the Fed has been running the largest financial experiment in human history. An experiment with your money, with your future. And it's about to blow up in spectacular fashion. I'm going to show you exactly how this $10 trillion time bomb was created, who's profiting from it, and why it's going to detonate by 2026. This isn't conspiracy theory. This is printed in the Fed's own reports. The receipts are public. The evidence is damning. And the mainstream media won't touch it because the truth is too terrifying. What I'm about to reveal affects every single person on this planet. This is the unfiltered truth they don't want you to know. Let's dive in. To understand this $10 trillion monster, we need to go back to 1913. That's when the Federal Reserve was created in a secret meeting on Jekyll Island, Georgia. A handful of the world's most powerful bankers crafted a central banking system that would give them control over America's money supply. They sold it to Congress as a way to prevent financial panics. The reality? They created the ultimate money printing machine. For decades, the Fed operated with some restraint. They had to. The dollar was backed by gold until 1971, which meant they couldn't just print unlimited amounts of currency. But when President Nixon severed the dollar's link to gold on August 15, 1971, everything changed. Suddenly, there was no anchor, no limit, just faith and the full backing of the U.S. government. This ushered in the era of pure fiat currency, money backed by nothing except the government's promise to pay. And here's where it gets interesting. To maintain global demand for this unbacked dollar, the United States made a deal with Saudi Arabia in 1974. Treasury Secretary William Simon flew to Riyadh and struck an agreement. Saudi Arabia would only accept U.S. dollars for oil, and in return, America would provide military protection and buy Saudi debt. This created the Petrodollar system. Every country that needed oil had to hold dollars. This artificial demand kept the dollar strong and allowed America to run massive deficits without consequence. We could print money, and the world would absorb it because they needed dollars to buy oil. It was financial genius, a monopoly on global currency backed by black gold instead of yellow gold. Fast forward to today, and we're seeing this entire system crack at the foundations. In 2023, Saudi Arabia announced they were open to selling oil and other currencies. China and Russia are conducting trade in yuan and rubles. The BRICS nations are actively working to create an alternative to dollar dominance. The petrodollar is dying, and with it, the artificial demand that's kept America's debt party going for 50 years. But here's what makes 2024 different from any other time in history. The Fed's balance sheet has exploded to levels that would have been unthinkable even a decade ago. In 2008, during the worst financial crisis since the Great Depression, the Fed's balance sheet was $900 billion. By 2014, after years of quantitative easing, it had ballooned to $4.5 trillion. Everyone thought that was insane. Economists warned of hyperinflation. Politicians demanded accountability. Then came 2020, and all hell broke loose. When COVID hit, the Fed didn't just print money. They unleashed a financial tsunami. In a matter of months, they expanded their balance sheet from $4 trillion to $9 trillion. That's $5 trillion created out of thin air. But it didn't stop there. By 2022, the balance sheet peaked at $9 trillion, and buried within that number is our $10 trillion problem. You see, the Fed didn't just buy Treasury bonds and mortgage-backed securities. They created entirely new lending facilities, overnight repos, reverse repos, the standing repo facility, the bank term funding program. These are shadow mechanisms that operate in the dark corners of the financial system. Invisible to the average person, but absolutely critical to keeping the entire house of cards standing. And here's the parallel that should terrify you. We've seen this before. In 1929, before the Great Depression, banks were using overnight lending and margin calls to create artificial liquidity. When everyone tried to cash out at once, the system collapsed. In 2008, banks were using overnight repos to fund their mortgage-backed security positions. When the music stopped, Lehman Brothers evaporated in 48 hours. History doesn't repeat, but it rhymes. And right now, it's rhyming in perfect meter. Now, let me introduce you to a term you've probably never heard. The Reverse Repurchase Agreement Facility, or RRP for short. This is where our story takes a dark turn. On the surface, the RRP sounds boring, technical, just another Fed program. But this facility is the secret mechanism that's created the $10 trillion problem, and it's operated by one of the most powerful yet unknown figures in global finance, Lori Logan, the manager of the System Open Market account. Who is Lori Logan? Most Americans couldn't pick her out of a lineup, but she controls the plumbing of the entire U.S. financial system. Every dollar that flows through the Fed's balance sheet crosses her desk, and under her watch, something unprecedented happened. In March 2021, money market funds started parking massive amounts of cash at the Fed through the RRP facility. Why? Because they had nowhere else to put it. The Fed had printed so much money that banks were literally drowning in cash. They couldn't lend it all out. They couldn't invest it safely. So they parked it at the Fed overnight and collected a tiny bit of interest. By June 2022, the RRP facility held $2.3 trillion. That's trillion with a T. Every single night, $2.3 trillion was being recycled through this one facility. But here's the twist that nobody's talking about. This created a hidden dependency. Banks became addicted to the RRP. It became their safety valve, their emergency exit, their guaranteed return in a world of uncertainty. And the Fed became dependent on it too, because without the RRP sucking up all that excess cash, inflation would have been even worse than the 9% we saw in 2022. But now, the RRP is draining. As of early 2024, it's down to around $500 billion. That means $1.8 trillion has flooded back into the financial system. And here's the question nobody wants to answer. Where's that money going? You won't believe what happens when that final $500 billion leaves the facility. The receipt is wilder than you think. And the person who's holding the bag? It's not the banks. It's not the Fed. It's you. Let me break down exactly how this machine works, because understanding the mechanics is the only way to see why this ends in disaster. First, let's talk about the Fed's balance sheet. Think of it like a bank's ledger. On one side, you have assets, things the Fed owns, like Treasury bonds and mortgage-backed securities. On the other side, you have liabilities, things the Fed owes, like currency in circulation and bank reserves. When the Fed does quantitative easing, they buy bonds from banks. They create money electronically and hand it to the banks in exchange for Treasury bonds or mortgages. This adds to both sides of the balance sheet. Assets go up because they now own more bonds. Liabilities go up because banks now have more reserves sitting in their Fed accounts. Here's the first shocking statistic. Between March 2020 and April 2022, the Fed purchased $4.6 trillion in assets. To put that in perspective, that's more than the entire U.S. federal budget in 2019. They created nearly $5 trillion in just 2 years. Now, when banks suddenly have trillions in extra reserves, they face a problem. They can't just sit on cash. They need to put it somewhere. Normally, they'd lend it out or invest it. But in 2020 and 2021, there weren't enough safe investments. Interest rates were at zero. The economy was in chaos. So the Fed created a solution, the Reverse Repo Facility. Here's how it works. Everyday banks and money market funds can lend their excess cash to the Fed overnight. The Fed takes the cash and gives them a Treasury bond as collateral. The next day, they swap back. The bank gets a tiny bit of interest, and the Fed gets to temporarily reduce the amount of cash sloshing around the system. Sounds harmless, right? Wrong. This facility became a black hole for liquidity. At its peak in June 2022, $233 trillion was cycling through the RRP every single day. That's more than the GDP of Canada every single day. Second shocking statistic, the RRP went from nearly zero in March 2021 to $2.33 trillion in 15 months. That's an increase of infinity percent, the fastest expansion of a Fed facility in history. But here's where it gets sinister. The RRP created a moral hazard. Banks no longer had to compete for deposits or make smart lending decisions. They could just park money at the Fed risk-free. This sucked capital out of the productive economy and trapped it in a sterile government facility. Meanwhile, the Fed started raising interest rates in 2022 to fight inflation. Remember, they'd printed trillions of dollars. Too much money chasing too few goods equals inflation. Economics 101. So they jacked up rates from 0% to 5.5% in less than 18 months. Third shocking statistic, this was the fastest rate hiking cycle since 1980, and it created a catastrophic problem. You see, when interest rates go up, the value of existing bonds goes down. It's an inverse relationship. The Fed owns $5 trillion in bonds that they bought when rates were at zero. Now, rates are at 5.5%. That means those bonds have lost tremendous value. How much? According to the Fed's own financial statements, they're sitting on over $1 trillion in unrealized losses. $1 trillion. That's more than the entire annual budget of the U.S. military. Fourth shocking statistic. If the Fed were a normal bank, they'd be insolvent. Completely bankrupt. But they're not a normal bank. They can print money to cover losses, which means they can create inflation to save themselves. Now, let's connect this to the RRP draining. As that $2.3 trillion leaves the facility and floods back into the economy, it has to go somewhere. Some of it goes into stocks, driving the market higher. Some goes into real estate, keeping housing prices elevated. But a lot of it is going into Treasury bonds because the government is running $2 trillion deficits and needs buyers. Here's the problem. The Fed is no longer buying those bonds. They're in quantitative tightening mode, letting bonds roll off their balance sheet. So who's buying the debt? Fifth shocking statistic. In 2023, the U.S. government issued $2.5 trillion in new debt. Foreign buyers purchased less than 20% of it. China and Japan are selling U.S. treasuries, not buying them. That means American institutions have to absorb all that debt. But there's only so much debt the private sector can absorb before yields have to rise. And when yields rise, the government's interest payments explode. We're already spending over $1 trillion per year just on interest payments. That's more than we spend on defense. Sixth shocking statistic. If interest rates stay at 5%, the U.S. will be spending $2 trillion per year on interest by 2026. That's 30% of all tax revenue going just to service debt. Not building roads, not funding schools, just interest. This creates a doom loop. Higher rates mean higher interest costs. Higher interest costs mean bigger deficits. Bigger deficits mean more borrowing. More borrowing means even more interest costs. Eventually, the only buyer left is the Fed, which means printing money, which means inflation, which means the dollar loses value. And here's the truly insidious part. The banks know this. They're preparing for it. Why do you think JP Morgan Chase has increased their gold reserves by 173% since 2019? Why has Bank of America been quietly accumulating hard assets? They see what's coming. Seventh shocking statistic. The four largest U.S. banks hold $4.8 trillion in derivatives exposure. That's leveraged bets on interest rates, currency values, and bond prices. When the system breaks, those derivatives could trigger a cascade of failures that makes 2008 look like a practice run. Let me paint you the scenario. It's late 2025 or early 2026. The RRP facility is completely drained. Treasury yields are spiking because nobody wants to buy U.S. debt at current rates. The government is facing a funding crisis. They need to issue bonds, but can't find buyers. The Fed faces a choice. Let interest rates rise to whatever level attracts buyers, which would crash the economy and the stock market. Or step in and buy the bonds themselves, which means printing trillions more dollars and destroying the dollar's value through inflation. Either choice is catastrophic. One gives you a deflationary depression. The other gives you hyperinflation. Both end with ordinary Americans losing their purchasing power, their savings, and their standard of living. This is parasitic finance at its worst. The system has been engineered to extract wealth from the productive economy and funnel it to the financial elite. When the collapse comes, the banks will get bailed out again. The politicians will print money to save the system. And you'll be left holding worthless paper. The greed is breathtaking. The moral hazard is complete. And the engineered collapse is right on schedule. Let me be absolutely clear about what's at stake here. This isn't just about numbers on a screen or abstract economic theory. This is about your ability to feed your family, to keep a roof over your head, to retire with dignity. When this $10 trillion shadow debt bomb detonates, the dollar will lose 40 to 60% of its purchasing power within 18 months. Your savings, your paycheck, your retirement account, all cut in half in real terms. Gas could hit $10 per gallon. Eggs could be $15 a dozen. A starter home could cost $800,000. This isn't fear-mongering. This is mathematics. This is the inevitable endpoint of a system built on infinite debt and money printing. The Fed has created a monster they can't control, and we're all going to pay the price. The global nature of this collapse makes it even worse. When the dollar breaks, it takes down the entire international financial system. Countries holding dollar reserves will see their wealth evaporate. Global trade will seize up. Supply chains will collapse. We could see food shortages, energy crises, and social unrest on a scale not seen since the 1930s. And here's the philosophical question that haunts me. Are we wiser now than we were in 1929, than we were in 2008? Or are we just walking the same path in better suits with fancier technology, telling ourselves this time is different? The warning signs are everywhere. You can see them if you choose to look. Rising debt, falling currency values, countries abandoning the dollar, central banks buying gold at record rates. The smart money is already moving. But most people are in denial. They trust the system because trusting the system is easier than facing the terrifying reality that it's built on borrowed time and printed money. They believe the experts who say everything is fine, even as those same experts load up on hard assets and foreign currencies. Don't be one of them. Don't wait until your dollar is worth 50 cents to wake up. The time to prepare is now. The time to understand what's happening is now. The time to position yourself for what's coming is now. I'm not telling you to panic. I'm telling you to pay attention, to educate yourself, to make informed decisions about your financial future. because when 2026 comes and this system breaks, you want to be on the right side of history. If this video opened your eyes, smash that like button and share it with everyone you know. Subscribe to this channel because I'm going to keep bringing you the truth that mainstream media won't touch. And leave a comment answering this question. Are we wiser now, or are we just repeating the same mistakes in a different era? The storm is coming. Don't wait until you're drowning to learn how to swim.